Once again, this is Matt with SN Mortgage Company, and today I'm talking about the list of things that a borrower is not supposed to do during the loan process and why there is so often a breakdown in communication between the loan officer and the borrower that causes these things to happen. Every mortgage professional has seen it. A borrower's loan looks clear to close, they're counting down the days to move in, and suddenly the lender gets notified that the borrower is no longer eligible because they made a fatal error, like a major purchase that shifted their debt to income ratio, or they signed up for a new credit card to save 10% on a not major purchase, or they suddenly started a new job. Any of these things can derail a loan because the approval and underwriting process is a delicate one, and that's why you need a loan officer who guides you through the process from start to finish and explains all of these things in advance, and also because the feds require it. If you work in the mortgage world, you see a ton of memes bemoaning the borrowers who derail their loan at the final hour. But whose fault is it really when these things happen? If the loan officer didn't warn you about common mistakes leading up to closing day, isn't that kind of their fault? Sometimes they forget that this isn't common knowledge to the average Josephine. Other times they explain it perfectly and the borrower does it anyway. That's obviously the borrower's fault. But most often, I believe the loan officer thinks that they communicated it perfectly, but from the borrower's perspective, it wasn't clear. Let me explain why I think that is. Loan officers usually issue these warnings as a list of don'ts, like the borrower commandments that I've shared before, or this lyrical number that we put together in the office. But sometimes borrowers receive this as rules of thumb to keep them from falling into financial poverty, which obviously would be bad. They only get the deeper explanation when they text their LO that they're in line at the furniture store, much to the LO's shock and horror. They don't realize the loan process requires a radical freeze on your usual money habits while your paperwork is under scrutiny. Don't freeze your credit though, that would be really bad too. The point is, don't shift your financial status in any way. And don't disappear either, because questions can come up at any time. So let's start with the rule you hear most. Don't open up new credit. It's not just because it's a slippery slope to falling into debt. It's because underwriters care exactly how many lines of credit you have open. Even if you don't do major spending, even if you cut up and cancel immediately, and even if it doesn't affect your credit score, a line of credit matters to the underwriters. They have to go back to square one if this changes mid-process. Don't do it. Changes of job, same rule applies. It's not only if you make less at your new job, or if you have an employment gap, or if it's a total career change, or even whether or not you quit the old job. It's about the way that the loan was sent to underwriting. Even if you add a minimum wage job on the weekends, that could be a reset. Unverified deposits. Again, you may think more money in the bank can't be bad. Oh yes, it can. All money must be accounted for. You need a paper trail. If your parents give you a gift and you think, well, I can prove that anytime that I need to, prove it right now. Make a paper trail. Don't wait. And by this point, I'm sure you figured out, large purchases and withdrawals are a no-no, even if you immediately replenish the money in your account. Don't shift anything. That's the rule. This also applies to non-financial things like separation and divorce. If it's on the record, it needs to stay that way through closing. Timing is everything. This is not the time. And if a situation comes up where you feel like you have to do one of these things, don't hide it from the loan officer. If you tell them, they might actually be able to find an exception, or they'll tell you if that would be impossible, and at least you'll avoid finding out at the closing table that your loan can't go through. Lastly, and this is not a trivial piece of the process, closing costs. If those aren't worked into the loan, you need to pay it. The loan officer should have been very clear that this is a separate fee from the down payment or the mortgage payment. You need to have that in your hands when it's time to close. So if you think I missed anything major in this list, let me know in the comments and maybe I can open up a discussion or add a new video to the series. And if your loan officer missed any of these things, send them this video. And subscribe to our channel for more videos like this.